So just so you know, I'm on the recording. Now, Chris, when you got the link, then what did you do at that point? Chris?
I don't understand the question. I seen the link and I clicked on it,
And then what happened?
and then you popped up, and now I'm here.
All right, what happened before that? Just so I know, because I've got to fix
Before
this.
it didn't even work at all. I had to refresh my screen.
I know, but when you tried to get into the meeting from the beginning, you just used the link?
Yes, sir.
So you've always just used the link. It was just a function of getting in with the link, right?
I never had an issue with any of my classes.
No, I'm talking about this class. When you got the
No.
link,
The first time it didn't work, I clicked on it, was waiting. 10 minutes went by. So I refreshed it, and now we're here. I clicked on the second link, and this one worked.
okay. All right. Well, at any rate, I'm gonna have to see how I'm gonna have to talk to the school because this has been a problem for me. See, then like on my end, I open up classes and I get this. Okay, now it's loading finally. And I get this. Huh? See what I'm getting here? I have it up here. Let's try that. Just want you to, okay, so here I am. Here's our class, right? I just sent out this link. Now, you guys see my screen? So maybe we could figure this out. Now, when I go to calendar, it's here. Here it is. Here it's in the class. So where I'm confused is why you couldn't see this. You see what I'm saying? Are you guys there?
I'm listening. From this screen, I never went to it recently.
Excuse me?
This screen particular, the calendar, I haven't
Yeah.
looked at it recently, so I don't know if it's there or not.
Yeah, I mean,
Okay, so you
I'm
don't
on
know,
the
but
calendar screen and there's nothing there for it or for the class.
I just don't get it because I set the class up here. Here's the class. I activated it. I mean, maybe I need to. I'm not going to do that. That doesn't look right. I got to tell you, Teams is the worst. It really is literally the worst. Now here's our classroom, and for some reason, here's our classroom. Here's our homepage. All right, I don't have anything there. See, and you're not seeing this, right? And I don't know why. Is it something maybe you have to activate on your end that you're not seeing it, John?
I have no idea. I don't know. But I
Yeah.
mean, and at least now I know I can get it in the announcements
Well, you'll
to
definitely
find
get
it.
it in. You'll definitely get an announcement. And what I've been doing is then I'll download it and I put it into a YouTube for people who can't get into Teams. I'm gonna have to figure this out later, but it's been extremely frustrating on my end. You can
Okay.
understand. All right. Well, at any rate, I'm Professor Strafaggi. Been teaching at Rasmussen for a while. I just finished developing a new couple of new classes. I'm in my mid 60s. I worked in finance for many years. I was on Wall Street for many years. Went to St. John's University. Of course, you could probably hear from my voice. I'm a New Yorker. At St. John's, I studied economics, accounting, and finance, and then later on studied statistical analysis when I went for my master's, and I worked on the trading desk and did a lot of stuff there. And then I started teaching about now it's almost 14 years ago. A buddy of mine who ran the stock trading at Morgan Stanley in New York. He and still very close to me, about 10 years older than me. Um, I hold on one second. I talked to him about getting into academia because I thought it would be a great thing to use my skill set on. And I was and we worked it out. I started teaching for him at Wagner College. It's a small school where I grew up by the Verrazano Bridge. I don't know if you've ever been to New York. And then from there, it's been a great ride. I teach here. I teach for Rutgers University, which is our state university. I teach for the city of New York, too. They have a university. I teach for the military. And I teach for a couple of the big colleges. I've developed classes for them. So the online courses at University of Maryland, the University of Arizona. and Purdue. So I've created classes there and taught there. So, I've got a nice background now in teaching, and went back for my doctorate, and I'm almost done with my final dissertation. I did it later in life. I have three sons. All My oldest is 37. He's got his PhD in engineering, and he lives up in Boston now. My middle guy, also an engineer, but went back to Rutgers and got his law degree, and he works as a general counsel in an engineering firm. And then my little guy, he's in finance. He works for the Securities and Exchange Commission in Manhattan. So I live off the Jersey Shore, but I'm like a 40-minute ferry ride to the stock exchange and to Lower Manhattan, and that's where I actually got my doctorate. I got it at Pace University. So I've taught these classes before, and I really like Rasmussen because they give you the you guys could see my screen, right? Just want to make sure.
Yeah,
Yes,
I
sir.
see it.
Great. So, yeah. So what I, this class, I've taught this class. I've taught a number of other classes. This is actually one of our first classes where we're introducing Microsoft McGraw-Hill Connect. Now, I've used McGraw-Hill Connect in other places. It's a very good system because, you have to keep answering questions. So you almost got like a little AI going on, where if you answer the question correctly, you move on. If you don't, they'll present you with the questions you didn't get right. Have you guys used it yet?
Yes,
I
sir.
have, yeah, the smart book where you read along, answer the questions and stuff like that.
Excellent, excellent. And the first chapter, and I've used this book, this pretty well-known book. First chapter is really mostly deals with it's introductory. It deals with um how what the basics of accounting, different business forms that you could use, how you start a company, whether you use uh, a partnership or go into a corporation. So that's what you're going to get in the first unit. You're going to get a lot of that. If you go back here, and I really urge you, and for those of you watching at home, and by the way, the code word is going to be spreadsheet. The code word is spreadsheet. All right. So if you go into here, once again, the code word is spreadsheet. If you go into here, this is, and I had to kind of, I wish it was a little neater, but at any rate, if you open it, um, let's see if I can do this. If you this that is not working. Okay, let me do something different. If you go to my accounting playlist, I have an economics playlist, I have a finance playlist. I shared with you in the announcements, and I have an accounting playlist. And I really urge you, if you want to get a head start on this stuff, is to go to the accounting playlist, right? So I'm going to open it up for you. I'm assuming you could see my YouTube channel. Is that correct?
Yeah,
Did you
yeah.
see it?
Yep, I see
I'm
it there.
sorry I keep asking, but I don't like sometimes when you reshare different things, you lose it, and I don't want to, So I got a finance academy, I got an economics academy, I got an accounting academy. So what I'm going to do here is I'm going to take that accounting academy and I'm going to copy that. Copy that. And everything you see with this kind of blue and yellow, those are the ones that you really should be looking at because we're going over the entire account. We're going over all the books and records of the accounting spread, of accounting. I go over the income statement, I go over the balance sheet, I go over the statement of cash flows. I'm going to delete this for a minute because I don't like the way it looks. Okay. And then I'm going to create this for you guys. So when you open it, and maybe we'll just look at one so you can get a head start and you can look at the rest yourself. I'm going to put this in as a link because that'll be easier for you. And I'm sorry if I seemed a little testy before. I'm just so frustrated with Teams. Everywhere else I teach, I use Zoom. So it's not an issue. But everything with Teams, even when you have meetings, it's a pain in the neck. I mean, I know Microsoft is great, but I don't think they can be all things to all people. I think that's the problem. Like you just saw, I can't figure out how to enable you guys. Like I would love to get this to you. I don't know why it's not happening, but that's a question for another day. But now when you hit this, what you're going to get is, John, I want to say something. I appreciate your help this morning, just so you know. Are you there, John?
Yeah, yeah, I'm here. Sorry, it takes me a minute to get to the mute button. No, no worry.
No.
I appreciate that. Yeah, it was just The whole thing was just a little confusing. That was all, man. And sorry
Yeah,
if
but
I
it's a
seemed
good,
a little
and
testy too, because I was just trying to understand what screens you were talking about, because it's clearly there's some type of disconnect between
well, let me tell you
them
something.
and
Let me
Teams
tell you
and
so,
all
let
that.
me let me tell you something. This is not the first time. It's every time I teach with teams. I have to like, how I get then people have a tough time finding the video. So what I normally do, since I have this channel, is like when we're done today, I'll download it and people could watch it on YouTube. It's just easier. And the beauty of that is if you go to my YouTube channel for Rasmussen, you could see all other classes and stuff. So it's pretty good. But at any
Yeah, see,
rate, let's,
that's what I thought it was when,
yeah.
because like I said, I was scrolling through everything and I saw this and I was like, maybe this is the live. Like I wasn't sure, but
Yeah.
now I get it. Now I
If I
understand.
can't fix it, then going forward, and for everybody at home, just use the link I put in messages. Just use that
Okay.
link. And then when it's done, I'll just create a YouTube for you. But at any rate, it's a workaround, I guess. All right, so let's just watch this first one. The income statement, how the income statement works. If you want on your own, and I urge you to do it, you can watch the one on balance sheet and income statement and all that other stuff. But watch this one. And then I've downloaded the spreadsheet. So you can actually go into Excel and um, you can actually go into Excel and you could click through and see how the accounting channel works. I see how the spreadsheet lines up the income statement and the balance sheet. But let's just watch one. So this way, at least you're used to it. But it's a great way to like refresh yourself on accounting. It's going to make everything you do in this class a lot easier. This is the first in a series of um, kind of a review of the basic accounting theory. This kind of works with finance classes. It also is very helpful if you're an accounting major. Either way, it's really helpful. As I have degrees in accounting, economics, and finance, I try to bring it all together and I teach statistics. I try to get it all together and present it in one format. So I've created this fictional company, Tom's River Corp, and there'll be 3 or 4 parts to this series because I want to start with the income statement. Then we'll do the balance sheet, retained earnings, statement of cash flows, and an overview. But if we let's focus, and this is an interactive um, spreadsheet, and that's why I created it, because by using it, you get an idea of how these statements should actually flow. So we see that on the income statement, and every company has an income statement, whether it's a small mom and pop business or it's a Business Machines Corporation. Either way, you are going to see an income statement. We'll get into the balance sheet in the next video. But here we have sales of, well, it's all in thousands, and you always want to watch out for that too when you're studying. So this is in thousands. So the sales for this company would be approximately 3,074,000. And if we take out the cost of goods sold, and watch up here, because that's, for those of you who have a good knowledge of Excel, you'll appreciate this. And if you don't, this is a chance for you to start to begin learning Excel. The cost of goods sold in this issue is 2,088,000. So when you subtract what it costs of raw materials to create these sales, and this is obviously something like a manufacturing company, service companies, finance companies are going to look a little different. And obviously that's why you have to keep studying to learn the different nuances. But at the end of the day, it all looks the same. So gross profits are 986,000. And notice up here, I subtracted sales from cost of goods sold. Now we take out our operating expenses. So selling expenses would basically be commissions, what you pay salespeople. Maybe you outsourced your sales. However that worked, the accountant would plug this into selling expense. Administrative expenses would obviously be legal, accounting, overall administration of the firm. And the reason why we break these out is we want to see what our profit margin is versus what our raw material cost is. And not just, and we're going to learn this in further videos, when we look at ratio analysis, we don't just compare our cost of goods sold on an absolute basis. We look at it relative to other companies within the industry. So for instance, in some industries, cost of goods sold might naturally be very high, and the company makes money on financing or different things. Here, in this particular industry, and we just made up this industry, we hope that this ratio of 986 to 3074 is commensurate with the other companies within the industry and make sense for that industry. And if it changes or varies by much, we're going to want to ask that question. So these numbers kind of are included when you start asking questions. Another expense might be the leases that we have on automobiles, on different copiers, things like that. And then a very important number is depreciation, which I'm going to spend some time in a different video on depreciation because it's such an important part of the of understanding finance. But basically and quickly, the government urges us to start businesses and create businesses because when we create businesses, we create work, we increase the GDP, and we have more people who are out in the workforce paying taxes. Then that's going to be another video. But what happens is when you build a building, when you do anything of a capital expenditure, a building, a truck, anything you buy, the government allows you to write it down against your earnings. So it becomes a non-cash expense because you've already spent the money, but you're able to deduct it from your earnings so you can pay less taxes. So again, this is a video for another time, but to some, it's like your mortgage. You don't actually pay the entire mortgage. You're paying the mortgage less the amount you deduct from your taxes. So depreciation is a way for the government to encourage us to invest in different things. So we get to deduct it from our taxes, and that becomes part of our expenses. And notice that our operating profits are now going to be the gross profits minus the operating expenses. So we have operating profits of 418, which was reduced by the depreciation. So then we take out our interest expense, and then we have our profit before taxes. And again, if you look up here, you'll see that helpful formula for how I did the Excel. So now the taxes actually come out of taxes. In this case, I just plugged in a number because I didn't use a percentage, but they were a percentage of our net profit pre-tax. And if you do 924 divided by 325, you're going to get that number. But notice that tax number, the pre-tax number, the number we generate, the number that generates our tax liability is inclusive of this depreciation number. So you see how if we didn't have depreciation, this number would be higher and we would pay more taxes. So the government is effectively picking up, if you do the math, and again, I can't say this enough, we'll do this in another video, the government is effectively picking up our tax rate because they're reducing our taxes. So afterwards, I'm with the government. Net profit post-tax will come out of these two numbers. And then any dividends we have to pay, preferred dividends, which is another subject, what a preferred stock is. It's basically debt. You know, it's not really equity. It comes on the equity side of the sheet and it helps banks and firms that need to show more equity. But at the end of the day, it's debt. It's like a debt, it's like a perpetual debt, but it is preferred. So we have to pay that dividend. And then that's the earnings that are available for our shareholders. In this case, we have 76,262,000 shares outstanding. And when you divide your earnings by your shares outstanding, you get that all-important EPS number. Again, another important metric. EPS is the way we could look at how much our shares are earning. For instance, if this stock was a $29 stock, our EPS would be earning 10% of the earn. Our earnings would be, our stock would be generating 10% of its value in earnings. And that would be our return on equity, so to speak. But there's more to that, and that's got to be another. This is more of an accounting treatise, but there's going to be more that I'm going to do in terms of EPS. That's important for me to explain to you. I'm going to put this under the Finance Academy, and I'm going to create an Accounting Academy, so you have both.
So the bottom line is, I would urge you to watch the other two. So you do the income balance sheet, unless you want to watch them right now. It's up to you guys. You want to see the balance sheet side? Because this would really help you in terms of moving on.
Yeah, if it helps moving on, I'd like to see it just to get a better understanding. If I have any
Tremendous.
questions while you're live.
Tremendous. And the other thing is when you open up your class, I know you could see this. There's the playlist, but you can also use finance and economics for your own self. And I will put this class when I download it, I'll stick it into Rasmussen, so you'll find it there. I'll give you the link. And then there's the interactive spreadsheet. So when you download this, I just want to show you this. And I think this is the best way to start this class, I have to tell you. And I'm glad you guys want to see the rest. If I go here and open this up, then you'll have the spreadsheet. You should save it because this is a great refresher. This is why I did it. So you enable editing and you'll see that you could just click through. There's sales, there's cost of goods sold. And then when I subtract sales from cost of goods sold, I get gross profit. And then there's my operating expenses and different expenses, depreciation, which remember, it's a non-cash expense. We'll be dealing with that. And then obviously, if I sum these up, I have all my operating expenses. And then if I take this minus this, I got operating profit. So you could just keep clicking through and you'll actually see how it all flows and how it gets calculated. So there won't be any mystery for you. So when you watch the video and then combine it with the work on the spreadsheet, now on the first page is the one big one, because you got the income statement and the balance sheet. The second tab is your statement of retained earnings, which is once you make money, you could either put it back in the firm or pay dividends, right? And the third is the statement of cash flows. And, that's a little more involved, but absolutely necessary. All right, so good. I'm glad that you guys like it. Let's go back. I'm going to close this. I'm going to go back to my, I'm sorry. I'm going to go back to my, stay with me. My accounting channel. And let's watch the balance sheet. Why not? This is the balance sheet. So this is part 2 of our accounting review, and this is the balance sheet of the same company. Remember last video we looked at the income statement. You can go back and refer to that. But the thing about the balance sheet is it's the other important part of the financial statement. You have your income statement, and the income statement flows into the balance sheet. So basically, the income statement is what you earn that year, and the balance sheet is is your statement of where you stand as a company at a particular point in time. So the balance sheet is designed, again, to balance. So debits and credits need to balance. And your trial balance, when you put entries in, the debits and credits have to balance each other. So if I debit an expense, I also have to credit care. I might have to credit, debit an expense. I might have to credit, a corresponding entry in order to make sure that my books balance. And then the balance sheet needs to balance. So if I got a credit for equity, then I might also want to see a corresponding entry in my cash account because people bought equity in my company. So you see how they're always balancing each side of the balance sheet. Now, in a typical balance sheet, you start on the left side, which are the assets, and you go most liquid. So we start with the most liquid assets. So begin with cash, which is obviously the most liquid asset you could hold because it's fungible and you can turn it into just about anything. In other words, you can exchange it for anything. That's the idea of liquidity. You don't have to. Liquidity is cash definitionally. And in this particular company, they have this much cash on the books. And once again, as a reminder, you always want to compare your balance sheet and the health of your balance sheet to others in your industry. Some companies might require a large cash holding. Some might require very little cash holding. But again, you have to kind of balance it against the companies in your industry. After that, we have marketable securities because that's pretty much a liquid. Those are liquid also. You can cash them in, you can sell them in the market. Accounts receivable is a little different. That's the money we lend to our customers to bring sales in. From time to time, we will offer terms to our customers. Lending, we will lend money to our customers. And accounts receivable represent the amount of loans on the book. Now, we expect that to become cash. In some cases, the auditor might do if an auditor comes in, they may look at it and say, well, they may take a haircut on it. We call it a haircut. They may say, we expect you based on past performance in the industry, that you're going to collect 95% of these receivables. So they may be a little more conservative in terms of the valuation. They're not going to count it as exactly cash. They may do the same thing with marketable securities because it isn't exactly cash. And obviously another, touchstone will be the inventories. From time to time, you might say, well, the inventories are cash related. It could be gold you're holding. Obviously, you could turn that. That's incredibly liquid. Or automobiles on a cost deal is not pretty liquid. But then again, if you have perishable products or things that can kind of deteriorate, like clothing, that inventory might have to be treated subject. So we'll learn later classes when we talk about ratios, we sometimes take out the inventory out of our current ratios because we know that the inventories could be subject to a lower valuation. So when you add these up, you get your current assets, and that's why I have it in yellow. And you'll notice I sum them up here. And then we get to the more illiquid assets, which is your land and building, your machinery and equipment, furnitures and fixtures, vehicles. These are things that are illiquid, capital goods, things that we use to make other things. And when we add the gross fixed assets at cost, at what it cost us, we're going to come up with that number. We sum it. And then you take away depreciation, which if you want to learn more about depreciation, please watch my video, my income statement video, where I really talk about depreciation. It's the amount the government allows us to write our assets down and deduct from our income. But so, and it's going to, and I'm going to do it its own. At one point, I like to do its own video to further explain depreciation. But basically, it's the write down of assets that we've written our income down by a certain amount, and we get the tax benefit. Obviously, if we sell these assets, our new cost basis will be this minus the depreciation. Again, go through my income statement video. And that would be the net. When you net them out, you get a net fixed asset. So when you add these two numbers, 7 and 15, I'm going by this side panel, we're going to get 3597. And when we go to the liability side, you basically have the same thing. You have the most liquid liabilities, which is accounts payable, money we owe to our vendors. Usually you want to bounce off your receivables and your payables. That's money we lend, money we owe. Notes payable, which is short-term borrowings. Think of it in a person like a credit card. And accruals, which are things we owe that we've used but we haven't paid for yet. So you might have a liability on your books, like say insurance, but when you close, you haven't paid the insurance bill yet, and that's a liability to your company. So say you had employee insurance, unemployment insurance. You might be accruing this expense, but you don't have to pay, say, in February, but then your books close in January, and you already have 4 months of this expense, but you would accrue that expense here. You can also accrue assets, and if you prepaid an expense, you would accrue that. And again, another subject for another day would be depreciation and accruals. We will definitely look at depreciation and accruals in another video, but because those are important. And I want to make this as comprehensive as possible, and I don't want to give you too much in one video. So when we add these up, we get total current liabilities. Add on the long-term debt, and now you have, and long-term debt is basically your long-term borrowings, and now you have total liability. And remember our identity, which is assets equals liability equals assets equal liabilities plus equity. So there we have our liability, 1643, and now we look at our equity, our preferred stock, our common stock, and that's what we had on the books when we sold the common stock. That's why we call paid in capital in excess of par. So we have the common stock that was like the par value of the stock we sold, and then we obviously, well, not obviously, but we received more money after par. People paid more for our stock than we actually had it on the books, because the par value of the stock is something you have to set in the beginning. So you might say we're going to call it a $10 par value, but when we actually sold the stock to the public, we might have gotten 20 or 25. Or as we sell it, we get higher prices. So we're going to have to add that to excess of par. Again, it's just like an accounting construct. But to understand it again, we have to put a par value on our stock. So like, again, they might have said, well, this was a $10 stock, but as they were selling it in secondary offerings, or as they're selling it in additional offerings, they might have gotten higher prices, or they did get higher prices. So you mostly will see this on the books. And then we have our retained earnings, which are earnings from the previous year, which we're going to go over a retained earnings statement in the next video. So when we add these up, we're going to get total equity. And when we add liabilities and equity up, we get our total liability and stockholders' equity. And notice that they both balance. And that's why we call it a balance sheet. So assets plus liabilities assets minus liabilities have to equal equity. Liabilities plus equity have to equal assets. Assets minus equity have to equal liabilities. Once I know two of them, I can figure out the third. Again, assets.
Okay, so did that help? I'm hoping it did. Hello?
Yes. Yeah, thank you.
All right, great.
Yeah,
So
thank you.
Terrific. So now you can watch the third one on your own, and you have the interactive spreadsheet. And again, we're going to make the code word spreadsheet. Now, the rest of this stuff you've already probably pretty familiar with at this point, but the one thing I did want to touch on are business forms. And business forms are different ways we could set up our business. So a sole proprietorship is the easiest way to do it, but you have liability. I mean, because it's basically the owner owning a business and just transferring the income over to their W-2. So while it gives you full control and it's easy to start, and most small businesses do that, the problem is hard to get funding because you're really just acting as a person and your business has to qualify for funding, and you have to handle all the risks, right? If there is a problem, now, of course, if you did something, God forbid, illegally, there you can't. There's no limiting that liability. Illegal is illegal. But if you just did something like, somebody slipped and fell in your property, or there was an accident or something like that, something that was not foreseeable but happened, you will be responsible personally. So I really would strongly avoid a sole proprietorship if you're going to be involved in starting or running your own business. On the other hand, a partnership that usually is done by, lawyers, accountants. You basically are owning a business and sharing the responsibility, also sharing the risk again, which can be a problem. Now, with a doctor or like a group of doctors, even lawyers, they can have malpractice insurance and things like that. But the partnerships can be real tricky. The best thing to have, and I always recommend this to most of my classes, you always like people nowadays always talking about having, additional income, starting side businesses. Well, if you're going to do something like that, whatever it is, I mean, it could be something as sophisticated as writing code for somebody. I know someone who does that, or it could be even something like, you bought a power washer and you do power washing on the side. Well, anything that's like a side business, you should really have a limited liability company, which is pretty simple to start in every state. You can probably do it online, or if you want to use a local lawyer, it shouldn't cost you more than $500. And this way, as you're earning money or you're doing things, you can write it off according to the IRS rules, and your income goes into this LLC and it passes over to you. So it's pretty cool in terms of using that. Okay. I would strongly recommend an LLC. The corporation is a way for us to raise big amounts of money, right? Corporations are separate entities. We basically, it's a way in this country, it becomes its own legal entity. You could raise a lot of capital that way. And um, and the bottom line is people from an economic standpoint, they contribute their resources into the corporation. We have agents that run the corporations, those are CEOs, but to make sure they're doing what we want them to do and that their interests co-align with us, that's called an agency problem. But then ultimately that corporation will generate income and become either dividend income, or people will work for them and earn get promoted, get shares, things like that. So these are, but the only downside to the corporate interest, and this is how this country has grown with corporations, is that there's very strong registration, and you have to, you're responsible for anything that you say is inaccurate that you should have known, and you put the wrong numbers out. You can be responsible criminally, according to Sarbanes-Oxley. And bottom line is, the corporation is a great way to grow a business, but on the other hand, heavily, heavily regulated because anyone can buy into it, and they've got to protect um, the public. Now, the accounting equation we just went over in those two videos, remember that assets equal liabilities plus equity. So if I know two, I can solve the third. If someone tells me the equity of a company, how much is owned by the shareholders, and what the assets are, I could subtract one from the other and get liabilities, or the other way around. And then these are just examples of different assets, liabilities, and equity. Again, you could find all of that in you can find all of that in my now that you've seen my videos, right? So things like assets would be cash, which is, and they're clearly an asset. Accounts receivable, which is money I lent to my customers to buy my product, and that's something I own. And when I collect it, it becomes cash. Supplies, which are things that I'm holding on to create new revenue. Prepaid insurance, which is insurance I didn't use yet, but I prepaid, so it's effectively an asset. It's something I use to build business, but I haven't used it yet, prepaid it. Equipment, obviously, you need equipment to do business, and buildings. So these are examples of assets. Liabilities would be accounts payable. Money is, I received raw materials, but I didn't pay for them yet. Wages payable, money I owe to my employees that I haven't paid for. At the end of it, just think about it. If I'm paying a bonus or I owe money like a salary, if I have to pay people, say on January 15th, and they've earned their money from, they pay monthly, say, and they earn money from December 15th to January 15th, but I close my books on December 31st. I have to account for that. I didn't pay 2 weeks of wages, and that's a liability, right? I owe it. Same thing with rent. I might close my books at a period in between my rent payments. It has to be accrued for because it becomes part of that month's income. So I want to be correct in terms of the 2 weeks I used going forward, and I got to show that as a liability. And then things like unearned revenue, notes payable. This is the same theory. These are things I haven't paid for yet, but I'm going to owe them. And if I close the books at a period in between when I pay them, I have to account for the weeks that I didn't pay because that has to go with that week's revenues in terms of balancing out the income statement. Does that make sense to everybody? Does that make sense?
Yep.
Great. Great, thank you. And then finally, equity is what I own. So the ultimate revenue becomes part of my revenue. Um, uh, Supply expense, wages expense, those become a sort of part of my revenue. Once I claim those expenses, um, they'll become part of my what I own, right? Common stock is clearly equity. Dividends are clearly equity. Retained earnings is clearly equity. So those things go into my equity side. All right, but these are the most important things you want to look at in terms of equity. So that's basically it, unless you guys have any questions. I'm going to stop sharing for a minute. Any questions?
No, sir.
None at the moment, no.
All right, so you have everything. I appreciate you guys coming. We'll try to do this every Friday. If I change it, I'll definitely send a link and I'm going to try to figure out why you're not seeing that. And I appreciate that. But I'm definitely going to send you the link every week. And use the same link. Spreadsheet's the code word, and I'm also going to download this so this way it makes it easy for you to just watch it and everybody else. Okay.
All right, thank you. Appreciate that.
And thank you for coming. Where are you guys from?
Connecticut.
You're right in my backyard. What part?
Over Danbury, across the border, Brewster.
Sure, I know. I know where that is. I know where that is.
Neighbors, yeah.
I got a buddy who lives up there, and I live right on the Jersey Shore, but grew up in New York, and I definitely know where Danbury is.
Yeah, nice.
Cool, really good. Well,
I
nice to
appreciate
meet
it,
you,
man.
Jim.
Nice to
Yeah,
meet you. Thank you.
nice to meet you. How about you, Chris? Where are you?
I'm from the Bronx, but I'm in Orlando right now.
So you're in Orlando, but you're from the Bronx?
Yeah.
That's cool. Good.
Matter of
All
fact, I
right.
do have one question, just
Sure.
a selfish question.
Huh.
For a real estate agent, what would you recommend? An LLC?
Absolutely. I always recommend an LLC. Always. And the reason why, now again, I'm going to be clear. And I don't think you're going to do anything wrong, but I say this generally. If you do something that's you're just not supposed to do and you knew that you did it, well, that's something you can't get away from. But if you just were not negligent and something happened on your premises or something went wrong and you shouldn't have known, but things happen, the limited liability company helps you because they can't penetrate your personal assets. And you can do write-offs, which is the best part. But you
But
want
even as
limited
opposed to an
liability
S corp,
company.
because there's
Yes.
other structures, like even as you wouldn't recommend an S corp.
Yeah, S corp is fine. I didn't think you knew about that. You could do S corp too. It's the same thing. It's just different structures.
That's
Any
what I was
place,
asking.
let me should say it this way, and that's great that you brought up S corp. Any place where you could do limited liability is where you want to be.
Okay.
Yeah.
So
So
not
always
the
want
S
to.
corp then. For a real estate agent, no, you would recommend?
No, I again talk to your tax person, but yeah, S corp is limited
Huh.
liability, so you'd be fine.
Oh,
It's
okay,
just,
okay.
I
Just
think,
for
I
the
think it's
umbrella.
just the way. If I recall, the S corp is more for how many partners are in it, and it's designed for different situations. But the S corp and the LLC, they both have limited liability. I'm almost positive. Double check
I
that.
see. Yeah,
But
yeah, yeah,
anywhere,
yeah.
just don't get into things like sole proprietorship, or we taking on the risk yourself. Because if something happens, again, I'm going to give you a simple example. You're running a deli, a delicatessen, and you have it in a proprietorship instead of a limited liability company, and somebody walks in your thing and falls and really gets hurt. No fault of your own. It just happened. You're responsible. They're going to come to your assets. Here you don't.
Got it. Thank you, sir.
All right, guys. I'll see you next week.
All right.
All right, see you next week.
See you next week.